No problem. Well, thanks, Eddie. Thanks, Top Step, and thanks for everybody that's joining today. Um, the webinar we did last week was basically most of the heavy lifting in terms of order flow, a lot of theoretical stuff, and this week we're not going to tax you so much. So what we're going to look at this week and next week is the practical application of order flow information, various ways in which order flow information can be used. Now, some of what is in here is the result of my own observation, and some of it is the result of discussions with other traders, and some of it is going to make a lot more sense when you do your own observation as well. Now, this isn't going to be two sessions of things that you must use in order to benefit from order flow. The goal is to give you a selection of ideas and for you to take what you need from it. So it's kind of like this week and next week is an order flow all-you-can-eat buffet. Now, we talked last week about order flow, and based on that session, we should have an understanding of at least a theory behind order flow. And if we just recap that, what we learned last week, liquidity or limit orders acts as floors and ceilings, and you can't move through a price until market orders eat all of the liquidity in the way. Now, liquidity has to fill in the wake of a one-way move, and that causes something we call a liquidity vacuum, which is a relative lack of liquidity behind a move. Pullbacks are often caused by nothing more than this temporary liquidity imbalance, which we can see when we compare the moving price with the moving order flow. And we actually looked at how we could see that visually using volume and cumulative delta to identify those vacuums. We also talked about reversals consisting of three elements, which was absorption, one side giving up, and the opposite side coming in force, and any or all of which may be present, and each of which is visible in the order flow, but not always necessarily in time to get the best entry. And all order flow tools are effectively a variation on that theme, and they all have benefits and drawbacks. And we looked at some of the benefits and drawbacks last week, and the use of maybe using one or more order flow tools, where one gives you a more zoomed out view and one gives you a more zoomed in view, which is kind of the order flow equivalent of the higher and lower time frame. Now, today we're going to look at the relationship between liquidity, the floors and ceilings, and price action. And then we're going to have a good look at scalping, and we're going to have a look at why you might want to consider shorter term trading. And we'll look at the areas that kind of traditional prop traders commonly look at to take scalp trades. And that actually means we're actually going to go over actual trade entry points, where to actually go into the trade. Okay. Now, liquidity, or the thickness of the floors and ceilings, is an essential part of reading order flow, but it's also an essential driver of price action. Now, liquidity is not constant within any particular market. So sure, crude oil is always going to be thinner than the ES, but the liquidity in any individual instrument is not constant, and it can change dramatically from day to day, and it is very useful if you understand the impact of those changes. Now, we often refer to markets as being thick or thin, so let's just make sure before we carry on that we actually understand what that means. So a thick market is one with larger bids and offers on the dome, and when we talk about a thick market, we're talking typically where the bids and offers are in the hundreds or the thousands, the high hundreds or the thousands, and we'd be looking at market like Euro stocks, the US Treasuries, the ES. So that's kind of the thick markets. And the thin markets are ones where the bids and offers are actually much smaller in size. So that would typically be less than 100, which is the Dow futures, the Nasdaq much of the time, a lot of the agricultural markets, crude oil, markets like that. Then there's really thin markets where you'll have less than 10 contracts quite often per level, so stuff like gold and DAX. Now, that's thin and thick, But we're going to talk about liquidity and volatility today. So let's also look at the term liquidity, because liquidity can be a bit confusing, because liquid or liquidity sounds a bit like something that's moving around, that's fluid. But the reality is liquidity has an inverse relationship to volatility. So the more liquid it is, the less volatile it is. Okay, so the more liquidity we have, the thicker the floors and the ceilings, and the less price will move, and the less volatile it will be. So with a more liquid, less volatile market, it means fewer intraday swings and smaller swing sizes. Now conversely, the thinner the market is, the less liquid it is, the more volatile and the more intraday swings you'll have, as well as a larger daily range. Okay, so liquidity is the opposite of volatility. Now, the amount of liquidity on any given market is going to change at the following times. So most of you will have seen this. The markets get really thin before news releases, and sometimes if you're actually watching a market trade and the market suddenly thins out, the chances are you've actually missed a news release. There's a news release coming out that you probably missed off your schedule. Now markets get thicker on the offer at all swing highs and the high of the day. Markets get thicker on the bid at all swing lows and the low of the day. And markets will also just change the liquidity picture for days or weeks at a time. So those of you here that were trading the ES through 2013 will know about this. You'll know the fact that ES market was continually changing pace all through 2013, and not just at the traditional holiday times. Now balanced or choppy markets are going to be thicker. So when we go like we've done this week, where we move up to a new high and then the market chops around a bit, the market balances a bit, those markets tend to be thicker. Uncertain markets will be thinner. And it also appears that at times I don't like to blame things on algorithms or HFT trading, but it does appear at times that algorithms get switched off and up to 60% of the liquidity will simply disappear. And when I say disappear, it will be there one day and it won't be there the next. Now that certainly occurs on the ES, and it certainly occurs on the US Treasuries. Now I don't closely follow other US markets to know if it happens there too, although saying that, I do know that it happens on the Nasdaq as well, because I do watch the Nasdaq when I'm trading the ES. Now interestingly, the VIX seems to be an extremely good predictor of tomorrow's volatility, and I suspect, but I don't know, that some amount of the liquidity is dependent on the VIX. So when you see the VIX spike, some of the liquidity absolutely will disappear, and of late that's usually been spiked to roughly 20 to 25. So when it gets above 20 to 25 on the VIX, the next day you will see 60% of the liquidity on the ES gets pulled. Okay, so the liquidity picture is changing all the time, and some of it you can predict, like the news, highs and lows of the days, VIX spiking, and some of it you can't. Now, in short, any market will have approximately the same liquidity much of the time, but it's prone to change, and you will need to take notice of this, and there's a very good reason for taking notice of this. So even if you don't use any order flow tools, the price action is going to be different when the liquidity changes. So it's a bit like playing baseball on different surfaces. So if you can imagine, running between bases in baseball, if you're on mud, or if you're on grass, or if you're on concrete, or if you're on ice, that's kind of how the markets work. So markets like the US Treasuries are a bit like these nuns in mud. I don't know where that picture came from, so if anybody wants that picture, it's not from some kind of fetish site. But markets like US Treasuries are more like running through mud. So if you were playing baseball on mud, you'd slowly trudge through the mud from one base to the other, and you would stop there exactly. In fact, when you look at markets like that, there's actually very little retrace back to a level once a market turns around. So it tends to go to a spot, and then when it moves away, it doesn't come back. Now, if you take the opposite of that, and I'm going to crack a joke, the polar opposite, a market like crude would be a bit like playing baseball on ice. So you'd run to the bases, you'd slide right past the base before stopping, and then you'd have to kind of gently come tiptoe back to base. And then markets like the ES are in the middle. We put in good runs, we do tend to turn back to lows and retest them, and we do have moderate retraces. And still the ES, even though it's thicker and it does have retraces, it is still well known for to the tick reversals of value areas, Globex range, prior days. But that's under normal liquidity. When the ES thins out, it is going to become more slippery and it is going to start sliding through levels before reversing. So if you try to take a reversal trade on the ES with a 4 to 6 tick stop, it's going to work on days where the liquidity is normal to above average. But on low liquidity days, you could be just as right about your trade, but you will be stopped out because of the extra volatility. So even if you are not using order flow, you should absolutely make yourself aware when the liquidity picture is changing, because it absolutely will affect the way that market moves. So here we can see a thin market next to a thick market. So we've got crude or CL on the left, and we've got Euro stocks or FESX on the right. So what we can see, obviously the depth is lower on crude compared to the FESX. The trades at each price on the volume profile as well is much, much lower on crude than the FESX. And if we look at the market profiles on the left and the right, we can see also that the daily trading range is much wider on crude. And obviously this is all very obvious, probably not learning much at this point. So volatility is a function of liquidity. So if one day the FESX for some reason had 10 to 20 contracts per level, it would absolutely move like crude oil. Okay, so all it takes you, okay, to know how liquid a market is, all it takes you to use order flow to have a look and to predict how liquid that market's going to be, how volatile your market's going to be on any day, is just take a look at the DOM once every 15 minutes. Get a feel for what kind of liquidity, what level of liquidity is typical, and be prepared for the price action to change as the liquidity changes. Now, there's a lot of discussion on trading forums about whether you need charts to trade or not. And in fact, we did a webinar on Top Step, which is called Trading Without Charts. Now, that doesn't mean I only think you should trade without charts. In my opinion, it really depends on the amount of intraday swings an instrument puts in. So the more intraday swings you have, the more developing levels you have to play off. Okay? And if you have a short-term memory like mine, which is fairly average, it's actually good to see where those swings occurred on a chart. Okay? Because I can't keep them in my head. Now, that's especially true if you want to capitalize from other people's stops. And we're going to talk a lot more about the stops later. But first, let's just have a look at the left at the crude oil here. Crude opened here and put in this small intraday range here. So we've got 105.85 at the bottom, 106.05 at the top. Now we can see that as that broke and as we came into this area going up here, we can see acceleration as that range broke upside. Now, as we came from the top and we moved down, we can actually see that that move was coming down very fast. But when the bottom of this range broke here, we got an even faster push down. That's just, we've got like some squashed up candles, probably 10 candles there. But this is just 2 candles in this move down here. Now, also, if we look onto the right here, we can actually see another little range here. And when this 105.50 area broke here again, we can see this push down. Okay, so that's a thinner market. Now, if you look over on the right, looking at the FESX, how does that chart really help you? Okay, if you look at the chart and you compare the chart here to the volume profile, I think there's a case to say that the volume profile is actually telling you a lot more about the chart. So I think there's an argument that says for trading outright positions, the more intraday swings you put in, the more useful intraday charts are. For less volatile markets with few intraday swings, the volume profile is actually going to tell you a lot more. Now, of course, it's not just the DOM that shows you the liquidity. Now, the DOM does show you intent, the limit orders, the resting orders, and that's kind of what people say they want to buy and sell. But obviously, a lot of what's on the DOM, it's just fake anyway and gets pulled. Now, both volume profiles and footprint charts are going to show you what people actually did buy and sell at each price. And of course, this is telling you how much liquidity actually was there and not just what they said they wanted to buy and sell. Now, this picture of the ES comes from March 2013, and it was one of those times last year where the market really slowed down and it just got thick, and it just kind of came out of the blue. And it's showing fairly high liquidity. So it's not just occasional prices with high volume here. It's regularly putting in levels where we've got 5,000 contracts or more. And that is exceptional liquidity for the ES. Now, as liquidity is perhaps the most important driver behind the personality of an instrument. When the liquidity changes, you can do one of two things. And what I'll say at this point, we're going to just stop for questions after we talk about liquidity. So if anybody's got any questions, now's a good time to type them in. So anyway, when liquidity changes, I'm advising you, you should understand liquidity. When liquidity changes, you can do one of a number of things. First of all, you can adjust to the volatility. And that means your trade size changes and your targets and stops change as well. Okay, that's one option. Another option you have is to not trade. Okay, and for those of you who haven't traded through the summertime chop, when everybody goes on holiday, not trading is a really good option. It becomes very illiquid at that point in time. Another thing you can do is you can move to a market that has the volatility you like to trade. Now, I am a big fan of trading the ES. US Treasuries, I could do it, but I really don't like it. It's very liquid, it's very slow, and I find it hard to keep focused. Now, when the liquidity gets reduced on the ES, it also gets pulled on the Treasuries 9 out of 10 times. So the kind of action that I'm used to trading on the ES is no longer on the ES. It's actually over on the Treasuries. Okay, so the ES isn't my comfort zone when all the liquidity gets pulled. What happens is my comfort zone gets moved to the Treasuries. And again, this isn't about order flow traders, right? This is about price action. If the personality of your market changes, it could mean the techniques you're using no longer work with those new volatility levels. So I think it's important to recognize that and to not get disillusioned with your trading. I speak to traders all the time that get disillusioned and say it's not working anymore. And I always ask them, has the market become more volatile? Has the liquidity changed? And it's also important to not keep throwing money at your method, hoping it will all work out. It's much better to find a market that has the liquidity, volatility levels that you're used to trading than trying to apply a technique or trying to force a technique onto a market that's really not suited for that anymore. So, do we have any questions at this point on liquidity and price action?
All right. So if you do have any questions, we are in the lounge. Please post your questions, and we'll get those. Topic right now is liquidity. All right. We've got IJK's got a question from JS. Is there somewhere you can go to find out the typical liquidity for a certain future?
That would be a great resource. I'm not sure of anything that exists. The only thing I know is just literally just take the dome and just look at the dome every 15 minutes. You'll be seeing, on the ES, you'll be seeing like 1200, usually to, 11, 1200 at, 1400 at a level mostly. You might see it a little bit smaller at the inside bid and offer. But of late, if you look at the ES, quite often you're seeing 5, 600. And then other times you'll see 3,000. So it's really just a matter of just keeping your eye on it. In DSP, what markets are liquid in say the summer if the ES falls off? Well, if the ES falls off, I take the option of not trading personally. So I don't really look around for another market in the summertime. Sorry, Eddie, you were doing the questions, right?
That's all right, Peter. Yeah, just so they know that I'm reading the questions, so we are answering questions. But yeah, DSP, I think that's it as far as questions. If we want to move on to the next topic.
Okay. So let me move on. Okay, so let's talk about scalping. And scalping in the year 2014 generally refers to very short-term directional trading. And that's what we're going to look at now. Now, scalping 15 years ago was a very different activity and generally referred to trading the bid-offer spread. So we're not going to kind of talk about that right now. And why would a trader consider taking short-term day trades? And part of the reason that this is worth considering is the learning curve. Now, the learning curve for position day trading, and when I say position day trading, I'm really talking about people who want to go, take a trade and kind of take it through a full swing on the, like 8, 9, 10 point swing on the ES. The learning curve for position day trading is quite long due to the fact that there is only, and this is going to sound really stupid, there is only one day per day. Okay? If your trading is based on how days unfold, then only one day is going to unfold in any 24-hour period. The other thing about position day trading is, as we've seen, especially in 2013, market conditions change over time. So if you've never traded the US summertime and then you're a position day trader, or any kind of day trader for that matter, then the summertime comes a bit of a shock. The second summertime, well, that's not going to be such a surprise. So it takes a long time to get to the point where you can look at the bigger picture and come up with the scenarios about how the day could play out. Okay? You make very few trades per day as a position day trader, so it takes, naturally, a lot of days for your trading skills to mature. Now with scalping, you're actually taking much shorter term opportunities which will crop up more frequently. So as such, you're going to experience a lot more trades per day. And that in essence is the benefit of scalping. Your scalping skills will mature in a shorter period than your bigger picture skills. Now that doesn't mean you can't develop the bigger picture skills at the same time that you're scalping. Okay? Now if you do it right, you can make money scalping sooner than you can position day trading. I really believe that. Now that doesn't mean that scalping is easy. Now, if you look at a bricks and mortar prop shop like Futex, Propex, probably some of the more well-known ones to us Brits, they tend to get their traders to scalp before they let them do anything else. So they're pretty open in terms of, you can pretty much trade how you like, but they really push you to do scalping first. And a lot of these prop shops won't actually allow the traders to use charts at all when they're actually developing these skills. And partly is because charts are kind of easy on the eye. So it's a matter of the prop shops wanting to get these guys to profit quickly. So if they can get somebody scalping live on 1 or 2 contracts in like 12, 14 weeks, then they can have them build up their skills from there if they actually decide that's what they want to do. And I know I know one guy that scalps, and he scalps 500 contracts. So he doesn't use a chart. He's not really interested in position day trading, and he makes decent money. Now, my market of choice is the ES. So on the ES, I'd consider anything up to a 4-tick trade a scalp, so 2 to 4 ticks. So where is it that scalpers actually take trades? Because I think a lot of people have got this vision of scalpers that they just like come into work, sit down, turn the PC on, and just start hitting trades. A bit like that picture up there. We've got the instant profit scalper, make profit every 1 minute. And I've kind of heard that point of view, but I've yet to meet a trader that does that or can do that or claims they can do that. Now, the scalp locations that I talk to people about are extremes. So most of the scalpers I know are still looking for an extreme to trade off. Now, an extreme doesn't mean that you have to wait for the high or the low of the day before you place a trade. There are short-term extremes that build up intraday. And the areas that we're going to look at now, we're going to look at 4 separate types of scalp trades. The first is trading around temporary value. Second is stop runs. Third is returning to an area that should be defended. And the final one is liquidity vacuum. So what we're going to do now, we're just going to run through each scalp trade one by one. Okay. Right, this sequence from left to right is a sequence from the Globex session on the 15th of July 2013. And what we can see here is something extremely common on all markets, where we move into an area and then we start moving sideways. So in this case, the area is 1673.50 to 1674.75 with a slight range extension here to 1675. Now this was in the Globex session on this day, and what we're looking at here from left to right is actually a few hours of action, or some people would actually call that a few hours of inaction. Now as I carry on talking through this, take a look at the volumes at each price from left to right. Now we can see a bit of range extension to the upside, but if you look at the volumes from left to right, you'll see which price is traded and where the opportunity was for entering and exiting scalp trades. Now the ES does this all the time, and so do thinner markets. It often does it right from the pit session open. So if you've got news at 10 a.m., quite often the market will just do this until that 10 a.m. news. Just because everybody's waiting, nobody knows which way it's going to go. Everyone wants to wait for the news. This kind of ranging can often last for an hour or more sometimes before it actually breaks out. Sometimes it'll just be a few minutes. It often happens after a decent move, up or down. And in the worst case, it can go on all day. And that's what we saw a lot of in 2013. And that's one of the reasons I really refined my scalping skills, because of that action that we had in 2013. And even in one day, you can see it push up, build a range, push up, build a range, push up, build a range. And we can get multiple of these ranges, but lasting just for a few minutes, providing you scalp opportunities through the day. And all that's happening at these points is effectively the market's balanced. It's two-sided trading. We've effectively got roughly the same amount of buy market and sell market orders. It's a temporary balance or a temporary value area. Okay. Now, in terms of what we traditionally call a value area is just effectively you take the highest volume price for the day and you grab 70% of the volume around that. So in terms of a temporary value area, we kind of look at it like, well, 73 here, 50 here would be our kind of value low. And the value low could be described as cheap. That's one way to describe a value low. And then 1674.75, that's our value high. Or another way to look at a value high is it's expensive. And then we've got this thing in the middle where we've got much more volume than the other prices, and that's called the point of control. And we tend to just rotate from cheap to expensive around that point of control. Now the visual characteristic of this kind of temporary value area is a bulge or a D shape in the volume profile. So we got this bulge here. The more symmetrical that is, the better that area will be and the more reliable it is to trade. So it's going to rotate between expensive and cheap, and the scalp trade is very simply to fade the highs and the lows, but with some confirmation to the order flow. So with consideration for those three elements of a reversal we discussed in the first webinar. Now, if the range is quite small, as in this case, it's a it's a simple all in, all out at each end. Now, the range is often going to expand, as is the case here. It'll probe out each side and come back into the range, which is basically what they call a head fake. Now, as the range gets larger, it's a good idea to scale some of your position off before you get to the POC. You wouldn't really have any room to do that in this small range here. Okay, and the reason you do that is because the POC is often the point at which it fails, but the market slows down there. It takes time to chew through that area. Now, the other thing you'll see with these temporary value areas is quite often it'll push to the outside of the range a number of ticks, and then it will go to the bottom and it will push to the bottom of the range the exact same number of ticks. So if you have had a range extension one side, when it gets to the other side, expect, if you see it actually break the bottom, have that expectation in your head that that could just be just another head fake to the downside. Now, these micro ranges or value areas form very often, and as that range starts to build initially, it's going to be a lot more visible on the volume profile than on the chart, and that is regardless of how much liquidity there is. So even on crude oil, to spot a temporary value area forming, the volume profile is definitely going to give you an edge in terms of spotting that. Now, after a while, after this range has developed for a while, so we can see from left to right, we're over an hour, it's going to be obvious from both the chart and the volume profile that this kind of temporary value area is formed, which means more people are paying attention to it, and it makes it more prone to being gamed. So the key here is getting used to watching these ranges develop, so you're taking the second and third hits at each extreme and not, say, the seventh hit at each extreme, because the more times you get to the extreme, the more likely that that is the time the range is going to fail. Now, there's a lot of people that call this chop, but there's a lot of people that call it chop and think there's absolutely nothing going on in the market. What they don't realise that while there's absolutely nothing going on, the scalpers moving in and out of those areas, taking 3 or 4 ticks up, 3 or 4 ticks down, 3 or 4 ticks up, 3 or 4 ticks down, all the while the chart traders are sitting on their hands thinking there's nothing going on. Now, if you do want to trade this way and you want to start scalping, pure scalping, doing this, the best thing to do is when the session opens is you sit on your hands for at least the first 15 minutes. Okay, and if you've got news at 10 a.m. and it starts out slow, then you're probably going to need to sit on your hands for 45 minutes until the reaction to the news at 10 a.m. Has kind of been washed out. So what you have to do, you have to effectively let the market open up and then show you where it wants to trade. If it moves directionally off the open, wait for volume to build somewhere before you start hitting into it. If it doesn't move directionally off the open, then let it build up some volume around those opening prices before you start hitting into it. Now, on any one instrument, on any one day, you should get multiple ranges to scalp per instrument. And there's no reason that you can't monitor multiple instruments at the same time. So with this type of trading, you don't need to have total concentration, focus, until you actually see the first signs that we're actually beginning to rotate, that we're actually building some volume around 1 or 2 prices. Now, when that happens, you're obviously going to need to focus in on that instrument and kind of tune into it. but you should be able to monitor 4 or 5 markets waiting for an opportunity to form. Okay. Now, if you're a trader like me, you're going to want to try and find 4 or 5 markets with equivalent volatility. So for me, if I'm looking at the ES, I might look at one of the treasuries. I'll probably look at the FESX. I might go for something a little bit thinner, like corn. But I'm trying to find a sweet spot so that I'm not looking at the ES on one screen and gold that's moving like 100 ticks on another screen, and trying to, detune from a thick market and then retune to a thin market as I switch around. Now at the bottom there, the Dubai Prop Trader site, it's just somebody's blog. It's a really good link to an explanation of how this guy performs this kind of trading. So if you're kind of interested in scalping these areas, this one's well worth a read. So that's temporary value. And the next one is trading into stops. Now, if you're paying attention, this picture might look familiar. And at some point, every trading range breaks. And some traders are going to be looking to capitalize on that. Now, my opinion is that you should probably start out doing one or the other. So you should either play the ranges or play the breaks. And if you watch the ranges form, and if you watch the ranges break, and maybe record them, with like Camtasia or something, you might find that you kind of work better with scalping the range, or you might find you kind of work better with breaks. You might find one of them is easier for you to spot. But playing a break is partly a function of how many times it's hit the extreme and the order flow leading into that extreme. So it's kind of unusual to see an extreme hit 7 or 8 times. Now, when I say an extreme being hit, I'm going to count all activity at an extreme as one hit. So, in this picture here, when we've got over on the, on the right, where our range is 73.50, 75.50, I've got 74.25 is the POC here. So if I came up to like 75.50 and I came down a couple of ticks, and I went up to 75.50 and I came down a couple of ticks, and I went up to 75.50, came down a couple of ticks, I'd count that as one hit. It's not really until it crosses down to this area that I say, okay, that's one hit, and that one hit is done. Okay, so that's what I mean by hitting the extreme 7 or 8 times. Now, when you play a break, you should be looking for supporting order flow to enter before it gets to the level you expect to break. And it's kind of simply because you want to have a little bit of cushion before you get to the extreme. So if you wanted to play a break of this area here, maybe a break of 75.25, you'd want to be trying to get in. Seeing buyers aggressively hit this, you probably want to be getting at 75, and then you've got a bit of a cushion there before you get to the top. Because if you are playing a momentum trade, and if it does hold at the top, you want to be able to get out before it kind of collapses back down. Now, the breaks are often going to follow a false reversal. So I'm going to try and talk you through a kind of false reversal. So in this example, you might see it trade down to 73.50 and then trade back up to 74, and you see the buying continue. You know that the people have faded 73.50. You know they're going to buy it up to the opposite end of the range, and you're going to see absorption on the offer. So what you're going to see is you're going to see the buying continue, but you're going to see it not actually being able to move the price up again. And what you might see buying in 74. You'll see an excessive amount of buying in 74. The buyer starts thinking, well, what's going on? Our buyer's not working. And then it'll tick up to 74.25, and the same thing will happen again. The buyers will say, okay, well, 74 broke. I'm at 74.25 now, and they keep buying in 74.25. But at 74.25, there'll be more absorption. So whereas you might have seen like 1,000 contracts or 600, 700, 800 contracts hit into a level, you might see a couple of thousand at 74. You might see another couple of thousand, 3,000 at 74.25. And what's happening there is somebody is building a short position at 74 and 74.25 before pushing the market back down. So as well as the kind of break where you go off the bottom and it just rushes through the top, what often happens is you come off the bottom, people get all excited, start buying it, and somebody just steps up. Okay. Now this is also quite often accompanied by the bids being stacked below the market as a sort of encouragement for people to go long off the low. And this is what is known as a flip. So I think lots and lots of people will have heard of the flipper. And it's called a flip because what they're doing, they put a lot of contracts on the bid. They don't intend to trade, but they're just putting bids underneath you to kind of encourage the buyers. And then when they flip, they just pull those bids out of the way. Bids disappear. They stack the offers, so they effectively flip from the bid side to the offer side, and then they start putting sell market orders in, and they push the market down. Now, partly it's the scalpers fading the range that they're taking advantage of. So, we talked about the range trade in the last slide, and it's a lot of those people getting stopped out are actually the range traders. So just be warned that if you play the range and it stops a few ticks after you've faded it, have a look to see if there's an above average amount of bids or offers on your side, and if there's a lot of absorption on the other side. Now, personally, I have a hard time from switching from fading levels to doing a breakout. Okay, so if I'm fading and it looks like the range is going to break this time, I have a hard time reversing and taking the breakout. So for me, I tend to get myself in a certain mindset. So if I'm basically fading the low, then that's what I want to do, and I find it hard to shift. Now, I also have a problem with playing both sides of a range. So for me, I don't mind fading one side of a range multiple times, but when it comes to going long at the bottom and then shorting the top and then going long at the bottom again, I kind of have a mental block. I'm kind of not comfortable in doing that. Now, I know other traders that feel like that too. So if you're not really versatile and the kind of guy who can fade both extremes and then take the breakout when it occurs, I wouldn't worry about that much because I think it's kind of a normal thing. Now, as we're talking about stops, it's probably worth going over stops a little bit because there seems to be a lot of confusion about them. And I say that because when I started trading, I used to hear people talk about the stops, and I was in awe of the smart people on internet forums, and they used to say things like, I don't trade like a retail trader. I just take advantage of retail traders' stops. And they'd never go into any detail. And I was like, God, man, I wish I knew what these guys were talking about. I wish I knew where the stops were. And I could never, ever figure out if the stops were above me or below me. I just couldn't figure it out. And it took me a while to realize the stops are, most of the time, above you and below you. Now, knowing where the stops are is basic common sense if you can put yourself in the other trader's shoes. So in this position, what we can see here is a move up. We've got longs in at the bottom, and we'll have longs that bought all the way to the top. Now, a lot of those longs are going to be short-term traders, and those are the ones you care about. Now, a lot of people are going to say, all these people that went long up here, those guys are buyers. And I try not to look at it like that, because sure, they did buy on the way up, but all of those traders that bought now are sellers, because that's what they're going to have to do to exit the position. So the way I see it, the higher we go, the more sellers we have. Now, the late longs start to feel a bit uncomfortable when the market comes back. And we've all done this. We've all chased a move, bought the high, and then seen the market turn against after entering. And so we all know how it feels. So right now, we know that with more additional downward movement, we're going to see those late longs, certainly the longs that got in above this point, start to exit their positions. Also, at this point, the shorts are probably feeling okay about their position because they've gone short. Even though they've gone short against momentum, they've gone short and the market's moved down. So the early longs are fine. The late longs are nervous. These early shorts that have just gone in on this move down are okay. And now the late longs are feeling a little better. Well, that would be the late longs except the ones that bailed out when it moved down. They'll be probably abusing the mouse. But the shorts, they're not feeling so good. So the shorts knew they were trading against the overall momentum. They'll have a line in the sand somewhere above the high where they're going to exit. So right now, at this point in time, I think it's fair to say with an area somewhere above the high where shorts will stop out, and an area somewhere below the low where longs will stop out. And obviously this is kind of common sense, right? Now, in this case, let's just say the shorts got caught out and the longs got lucky. So this isn't rocket science. We've all been the early long, we've all been the late long, we've all been the early short. We all know exactly how it feels. So there's no single area where stops are. There are areas where stops are. Now, if we go back at what we talked about scalping, when we look at the scenario where the market goes into a range or temporary value, we're going to see stops either side, and we're going to see a balanced market. So in this case, when we're at this particular juncture, we've actually got a pullback which is slightly elongated. It's a bit deep and it looks like a reversal. So at this point, we've probably got some longs itching to get out, and they'll probably get out if this low is breached. But as we go into a range, the picture is going to start to change a little bit. Okay, so when we get into this range or temporary value, the longer that sideways market goes on, the more balanced it becomes in terms of stops either side. So if we just go back, we know at this point, if we drop down to this swing low, there's going to be quite a lot of longs. In fact, most of the longs on the way up are going to be looking this swing low as a line in the sand. And that kind of gives us a rapid move down. If we get to this point, it becomes a bit more balanced in terms of the stop scenario. Okay, so we've already said we're going to have scalpers playing either side of the range, and we're still going to have some late longs, and we're going to have some shorts. So you'll still get a break to one side. Yeah, it's still going to go one side or the other eventually, but you're more likely to have head fakes after this sort of sideways action. Okay, and we're going to talk about head fakes. So the breaks are going to be more reliable if we just break a prior swing without the sideways action. So the false breakouts or head fakes are really, really common. So those are the ones where it goes a few ticks through the top. Some of the faders are going to be stopped out, and then price just moves back to the opposite side of the range, and quite often then moves a couple of ticks through the bottom. People get caught out, and we go back in. So be a bit wary in terms of stops. Just be a bit wary that after you've done the sideways move, the kind of stop dynamics are changing a little bit, because ultimately what will happen is a lot of these longs that get in all the way up to the top, they're going to have time to get out. They're going to see it going sideways, and a lot of those longs will just basically get out of the market, and the market becomes slightly less imbalanced. Okay, and what do we mean by imbalance? There's no magic in terms of knowing where the stops are. A simple short-term price chart is going to tell you that. And like I say, much of the time, the stops are both above you and below you. But even if you know where stops are, you don't actually know if they're going to be hit, right? So what does help us is to know how much fuel is on the fire and how many traders are trapped either side. And imbalances and volume at price helps us in that respect. So imbalances in the order flow are very, very, very normal. In fact, they're expected. So we talked in the first webinar that on any move up, you will generally see the buy market orders exceed sell market orders 1.5, 2, 3 times. So when we get one-sided trading, that's kind of the opposite of this range-bound trading. So one-sided trading, yes, we're going to expect an imbalance, because otherwise we're not really going to get any direction. So what causes a kind of backlash is, or what's the trigger, is when the order flow is one-sided, but then price is no longer moving. Okay, so when buy market orders exceed sell market orders and we can't move up, not only do you have an imbalance at that point caused by the buyers exceeding sellers on the way up, you also have a catalyst of the price getting stuck in the face of more buying and those buyers getting nervous. So it's this catalyst combined with the imbalance often initiates a move in the opposite direction. It doesn't necessarily sustain the move, but it can initiate it. So let's just look at two scenarios where we're going to look at a situation where we go straight up and down, and then another scenario where we actually range first. So in this case, what we can see is the delta is positive as we go left to right. Buyers are exceeding sellers towards the top. In other words, we are now gathering future sellers. People have bought. They will need to sell to take profit. Now, you remember the footprint chart shows us the action on the way up and the way down. But what we can see at this high here is absorption at the top. Okay, so we've got this exceptional volume at the top, and then the selling on the way down as we come down off the top. Now we come to this price here, 75.25, and we see 3,000 contracts on the bid. Okay, now that 3,000 contracts on the bid is the buyers attempting to defend that price. Now when it breaks down, then it breaks quickly. Okay, now how do you know that that was fast? Okay, well, we can see that what happens here is the sellers take all the bids and there is absolutely no buying. There is very, very little buying. And this stops getting hit. The market's not going to spend much time there because, as we get to each level, we get to trade this level. Any stops there are going to get triggered as soon as one contract trades. Okay, so what happens? We get some trading at this price. The stops get hit. We immediately get all those stops. We go to the next price, stops get hit. Go to the next price, stops get hit. So when we look at the right here, we're actually seeing very low numbers on the buy side just because it didn't actually spend much time trading these contracts on the left. Okay, so that's how we know that was a stop run. Now, of course, internet trading wisdom says that can't be stops because all ES traders have eight tick stops. And that's not really the case. So, of course, around every major swing highs and lows, there are going to be stops. But when you see an effort like this, to hold the market, the people that are trying to hold the market are going to get out as soon as they realize they've lost control. Okay? It's the same when people buy into a high and they get no move up. They do not wait 8 ticks before they exit. So this is a good example of a clean reversal with no ranging action. So we get the absorption at the top, and eventually the buyers know they're done. They bail out, and then we carry on moving down. Now this picture shows something different, and it shows how things become a little less clear when we range and then reverse. So if we look at the bottom, as we go from left to right, yeah, we can see that here we did have some seller commitment. But as we go along, we can see that both sides are trading heavily. Okay, so overall we're imbalanced to the downside, but really considering all the trading that's gone through, 10,000 here, 9,000 here, 6,000 here, the imbalance is quite small. And then we got this last attempt to push down here, this last attempt here, where we add some more to the imbalance. Okay. And then after we've added to the imbalance that final time, we move up. Now, of course, a move either side of this range is going to see some traders getting stopped out. But in this case, the potential was always kind of greater to the upside. The potential for a continuation move is always greater to the upside because of all of these sellers that have to buy to exit. But as we move up, we don't see that sort of one-sided action where if we're looking at the case where it would be stops, we would see size on the buy side, but you'd see very little size on the sell side. And we don't see that. And the reason is that as we came down, people have had chance to exit those positions. People have had chance to get out of their short positions in this sideways range. So you don't get the same kind of pop that you do when you move up and straight down through stops. Okay, so the next scalp trade is return to defense, and it's very simply a trade in an area where there's a lot of traders committed, but they're not necessarily trapped. So these areas tend to get tested, but they're certainly not always evident on a chart. So in this image, we can see a lot of volume at the top, okay? And then price moves down away from that area as the sellers wrestle control from the buyers. Now we can see a fairly big imbalance here, 16,000 contracts. So we can see there is fuel on the fire there. Now, after moving down, we can see that on the move down, we didn't really see evidence that people have got stopped out. So as we move down, we move back up to this area here. We've got 5,000 on each side. We move back up there, and just 146 contracts trade. Nobody wants to buy into that price. And then we start to move down. And it's when we've got to just about here that we then see the stops start to fire. And again, we know the stops are fired because basically one contract, 76 contracts, 400 contracts. We've got all the trading heavier on the left side, very little trading on the right hand side. So very little buy market activity as we're moving down. Now the move eventually isn't what you'd call a sustained move, okay? So we had the volume here, we moved away from it, we came back up to that area. Yeah, we got a push down, it wasn't a massive push down, 6 points or so. But this kind of trading isn't about trying to find a 10-point move, it's really about scalping. So you'd need to combine this with another method of maybe defining a trade location or some form of bias to turn this into a method, the way you could actually say, right, I'm going to use that entry technique, but I'm actually going to use it for long-term trading. Now in this image, we can see high volume occurred mid-range. Now, yeah, okay, it looks like a battle between the bulls and the bears. Really don't know 100% if that was the case, but we do know that we moved down after this volume put in. We do know some of the longs got washed out. So we moved down again and we came back to this area. Nobody wants to buy it. The buyers just got burnt there basically. So all these guys that bought at these prices, they got burnt. Not interested in buying it again. Plus, of course, there's people like me who won't buy there because they're actually using this method of analyzing the market. Now in this case, we don't get an immediate sustained move, but what we have is we have the potential to enter one tick below the high volume. So for me, if I want to enter a market, leaning on high volume, I'm trying to put a limit order in, or one tick below, or I'm waiting for the market to come up to here to put a sell market order in. You won't get filled. Generally speaking, you will not get filled if you try and sell the bottom of this high volume area. Okay, so at this point for me, I'd probably be filled around here, and I'd probably still be in that trade because I'd be looking for 4 ticks. So that's another return to value. Very, very simple concept. Very simple concept. You're not going to win every trade, but basically your risk is limited because basically if that market now comes up to this area here, 76.50, your premise is incorrect. Your trade's over. Okay, so you've got potentially an entry here, 3 ticks risk. Now the last scalp is trading a liquidity vacuum. Now we discussed liquidity vacuums earlier on and we went into more detail on them in last week's webinar. Now I'm not a big fan of scalping into a liquidity vacuum. So a liquidity vacuum is a pullback. And if you trade into a pullback, so the market's moving up, you'd be going short into a pullback. You'd be trading against momentum. And you'd already be, by telling yourself this is a liquidity vacuum, you're effectively capping your reward. Because you're going short in an uptrend into a liquidity vacuum that you expect to fail. Now, if you're the don of liquidity vacuums and you can recognize them every time and scalp them, that's fantastic. It's really something I wouldn't do. Now, on the other hand, when the market pulls back into a vacuum, you're effectively looking for continuation, and it's a higher probability trade because of that. So you're waiting for counter trend momentum to stop. And the nature of a liquidity vacuum is that the momentum on the way down through that vacuum has to be weaker. Okay, if it's not weaker, if there's real momentum there that you can see, it's not a vacuum. Now, the liquidity vacuums, they tend to be uniform in size. So on the ES, you're probably going to see 6 to 8 tick pullbacks on the way down. And then when that market reverses up, as the ES does 3 or 4 times a day, you're going to see the exact same size pullbacks on the way up. Now, of course, that's going to be dependent on how thick and therefore how volatile the market is on that day. So when the ES is thinner and it's putting in 11 tick pullbacks on the way down, then you're going to need to look at 11 ticks on the way back up. So with these trades, with a liquidity vacuum, it's not so much about what you see as what you don't see. So in a pullback, in an up move, you do not want to see large sell market orders aggressively hitting the bid. You do not want to see rapid momentum downwards, and you do not want to see sell market orders double the buy market orders. You don't want to see that imbalance on the way down, because you're expecting this just to be a balanced market where the vacuum is pulling you down. Now, if you do see some large sell market orders, and there's always going to be some, okay, what you want to see, what you ideally want to see, is you want to see some of those large sellers get stuck. Okay, so if you see 3 or 4 200 lot traders selling when you think it's coming down to a vacuum in an uptrend, and then you see them not getting anything for their money, that's exactly when you want to hit the market. That's exactly where the pullback's going to end. So you're going to see those guys selling into the market. They know they're counter trend players. They know they're trading against the flow of the market. And when they don't get any movement for their money, give it 30 seconds, give it 1 minute, the market's going to shoot up. So that's the liquidity vacuum. And as I said, this is a kind of an easy webinar this week. We are finished at that point, looking at scalp locations. So at this point, do we have any questions?
All right. If you do have questions, could you please post those in the lounge, and we'll get to those right now. I think we got some questions coming from the Russian room, so we'll wait till they let them post those questions in there. There were some other questions, and I asked them if we can do those Tuesday and Thursday. They have a screenshot, and we can move on from there. But any questions that you do have, please join us in the lounge here. And
I think there's some questions in the chat room as well. Let me just paste those in. You can go through them, Eddie.
Okay. Let's see here. All right, thanks, Peter. Viewer 226. What's the time frame of the volume profile?
Okay, for me, I don't reset the volume profile. I only trade the US mornings, so usually there's no reason for me to reset the volume profile, because we just build the volumes at each price, and I can trade off that. So for me, my volume profile starts at the US pit session, and I don't reset it.
All right. That was a question. Do you reset it at the swing higher low and when you suspect absorption is occurring? Next question is, would you say that scalp is 2 ticks on the U.S. Treasury as well as the ES?
Now, most of the guys I know that trade the treasuries, they don't really have targets. They are often out at 1 tick on a scalp, but they because it's so thick, they tend to get in, and then as long as momentum is on their side, they'll stay in. So I know a lot of guys that trade the treasuries, and they will be literally trading for 1 or 2 ticks at a time.
Okay. Next question. This is from Pijot. Are there any stats collected for these setups?
Not that I know of. I certainly don't have stats myself.
Okay. Moneypenny says a question. How do you stop a market order?
I think that's spot.
Okay. How do you? Could go either way. How do you spot a market order?
Well, every trade's a market order because, or really, actually, market order is the wrong term. There's something called an actionable order. So if you had the inside offer at 1500 and you tried to put in a limit order buy at 1500, that would action straight away because you're actually hitting the offer with a bid. So actually, actionable order is probably the correct term, but there's no way to spot it because it's an order that gets submitted and executed straight away. But basically, historically, the market order is what appears on time and sales and what appears on the footprint. Everything that we see in order flow historically is a market order.
All right. Question coming from the RU room. I'm going to skip that one. But could you comment on the diagonal delta in footprint, please?
Okay, this is a very good point actually. When you're looking at the footprint, in fact, go back to a footprint. All right, let me just bring that up. Okay, so this is a footprint, and what you got to think about is your bid and your offer price are always they're never at the same price. So when you're looking at a footprint, you don't compare the volume at the same price. You don't compare the volume on the sell side and the bid side at the same price. You look diagonally up. So at any one time, the offer on the ES is always one tick above the bid. So if you're looking for an imbalance, if you see 5,000 and one tick below, see 5,000 hit into the offer and one tick below 5,000 hit into the bid, that's a balanced market. Where you see this example here, we got 43 on the left, 110 on the right. You could say, well, that's an imbalanced market, but actually you should be comparing the 43 here with the 42 there because those are the two prices that were trading at that time. So yeah, I don't know if somebody's actually programmed a diagonal footprint. I know Market Delta I think did, but yeah, absolutely. If you're looking for imbalance, you shouldn't be comparing at the same price. But I don't think you specifically need a special chart or a special footprint for it. I think you can actually look diagonally with your eyes.
All right, thanks, Peter. Thriddler's got a question. Would you say that your homework, studying the market pre-open, influences your first half an hour, 45 minutes of trading?
Yeah, absolutely. It influences my whole day's trading, to be honest. You know, basically, I have my homework, which tells me, okay, this is how I think the day is going to play out, and then I try and use that as clues to get my bias. But I'm still looking for shorter term trades. But yeah, I really, really do. If I didn't do the homework, I wouldn't be able to trade. I would feel lost.
All right, IJK has a question. Can you go over what you meant when you talked about twice the sellers as buyers and market not moving?
Okay. If we look at this footprint, find an imbalance down here. Basically, we're talking about an imbalance. I don't have an example here. We're going to say basically, if we had sellers down the bottom here, we got 1,026, 1,500 here. If you saw a lot more volume on this side, but market moving down, then that would kind of be the sellers hitting into it aggressively and not moving down. But what you're generally going to see as you move up, when a move initiates, you will see as you move up, generally speaking, more trades on the offer side than you do on the bid side. Okay. Now the problem with the footprint here is you see all the trades on the way up and the way down. Okay. The footprint's not a very good tool to use historically.
All right, thank you, Peter. Futures MD. Let's see, Metro Diagonal S. No, it's not the question. IJK again. Are you talking about what's in the book or actual twice the bids being hit?
I'm talking about the actual executions. I'm talking about so not what's in the book. I tend to, largely with order flow, you can kind of ignore what's in the book for probably 90% of the time. So I'm talking about what actually trades.
Okay. All right, just a comment from MD talking about the volume ladder. You can find those on Metro Edition. Okay. Any more questions? Please put them in the lounge. We're in the lounge. And otherwise, Peter, I appreciate the time here. I think we're just about done here, and perfect timing. So, Ladies and gentlemen, Peter Davies of jigsawtrading.com. And Peter, while we do have you here, we do have a lot of guests. Is there, you give us a little detail on Jigsaw Trading?
Yeah, okay, so Jigsaw, we do order flow software, but really our software, it's not really, we haven't really shown it today because we're talking about order flow concept trade locations. We do software that lets you analyze the order flow in the very short term. We'll actually look at those kind of techniques next week. But we do software for order flow analysis. We also have a lot of free information on our site for people who are looking to learn how to use order flow or considering whether order flow will help in their trading. If you go to jigsawtrading.com, you'll see a lot of free lessons, and then you'll get basically a feel for what we do.
All right. I just posted in the lounge. I got Peter's website there. It's jigsawtrading.com. So check that out if you could. And I'll also post that in the Squawk Radio Room. But Peter, appreciate the time. I know it's very late over there, and it is the beginning of the weekend. So wish you well. And until next time, we're going to have you back again here for part 2. So keep your ears open. We'll have the lounge, or I'm sorry, we'll have the Squawk Radio open again for guests, open house, and we'll have Peter back.
Thanks, Eddie, and everybody have a great weekend. And
all right, we will.
Forget about trading for the weekend. It'll still be there on Monday.
Yeah, it'll be there, guaranteed. All right, Peter. Thanks a lot, my friend.
Cheers.
You have a good one.
Okay, bye.